Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Hey, this is kind of cool. Watch this.
It's
Let's
20
see.
pages. 20 pages.
20 pages.
All on one topic.
All on one topic. Wow, that's pretty cool. That is a tiny little snippet from our Talking Real Money video cast on YouTube.
Yeah.
And that was you speaking.
I kind of recognize the voice.
And every single, they have closed captioning now on YouTube.
Gosh.
They do it for you. And every word you spoke was read by the computer and typed on the screen entirely accurately. Thank you,
Ooh.
YouTube, for being able to understand Tom, because the rest of us are having
finally
issues with
someone
understands it. And
no one understands me.
And to think it's a computer. Mm-hmm. The thing that he hates more than anything in the world.
I don't know about that. You're working on being a strong number 2, so keep going.
Okay, I'm that's where I usually land, is right about number 2. Hello, everyone. Welcome. By the way, is this a holiday? It's not a holiday, right?
Every weekend apparently is a holiday in America. So what could you say?
Okay, it's not a holiday
sure
for
there's
us.
a reason.
So we're here. We're like, unless you're listening to the podcast on Monday, we're actually just here with you to do something incredibly, ridiculously important with you. You get to participate, and that is talk about money. How you make it, save it, invest it, spend it, plan for it, avoid being ripped off by people who are trying to take it from you, and a whole lot more. And to participate in the program today, all you need to do is find that device that makes phone calls. It's not just a text machine. No, you can actually speak with someone on it. Did you know that?
Ooh.
Kids?
Rarely, but yes.
Kids, did you know you could talk to people on your phone?
My kid doesn't, but
just voice to voice, not video, but voice to voice. All you do to talk to us is just, ready? There's a thing called a phone number, and on your phone, you hit that little green thing that looks like, well, I'm sorry, you don't even know what that is, do you? That green thing that looks like a sideways U.
Yeah, it says phone.
That's the phone. Mm-hmm. And you just dial these numbers. Ready? Dial. I'm sorry, you don't know what dial means, do you? I'm sorry, kids. Push these buttons. 855-935-8255. And if you look really closely at your little phone dialing apparatus there, you'll see that 8255, there are little tiny numbers or letters underneath it. And those actually spell T-A-L-K.
Woo! Like as in
talk. Talking.
Wow.
Yeah, that's what we do.
Wow. Okay.
I'm Don McDonald. Tom, that's that guy over there in the Model Military Museum.
No, I'm moving outside today. I'm going to be in my WT pool.
WT pool.
Yeah.
And you didn't go for the 52-foot one. I can't believe it.
Because I didn't want to make you do laps. You said if I got the 52-footer, you'd come over and do laps in it.
Do laps. Hey, and Tom, by the way, did you watch the video cast this week?
I don't think I did, no. Uh-oh.
There's so much good stuff in that I put in there just for Tom. And he hasn't even watched it.
I will go back. I
went to a lot of work to make this one special for you.
Now you're going to make me feel I will go back.
I can't believe you didn't watch our video cast. Gee.
Good Lord, come on.
That's just the way he is. He doesn't care. Love me anymore.
I wouldn't say that either. Priorities.
All right, here's what we're going to talk about right now, because we know you're all out enjoying that incredible
Late
Seattle
arriving
sunshine that the area's know. That's why they call it the Sunshine City. Don't they call it that?
Those 4 days every summer.
Yeah.
Sure.
So we're going to talk about something that's really important, which is a topic we talk about a lot, but we're going to talk about maybe the most important part of this process. we're talking about retirement. But we want to talk about, 1 year you're quitting work and you need to live off of other sources of income because nobody is going to take care of you. Your parents are dead. I'm sorry. You have to take care of yourself. Either they're dead or you're still helping take care of them, probably. Yeah. So you got to do this on your own. And we keep doing dumb things. So we're going to talk about how you do smart things. One of the things last year, before the market fell, we got lots of calls and lots of notes from people saying, my broker or my advisor or my friend is saying I should get in these great dividend stocks.
Which is what? What does that mean? Dividend stocks.
Stocks that pay dividends every quarter. And, there are some stocks out there that are paying, 7% dividends, 8% dividends. I'm saying you can live large on these things and the risk is low because these are big companies. Let's talk about that risk.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And look, just like that, we've come back. I'm Don, that's Tom, talking about money, dividends, actually. And there was a great temptation last year to buy into individual dividend stocks or dividend stock mutual funds because last year, short to intermediate term bonds, high-quality bonds, were yielding 1% or less in most cases. And so investors are out looking for a better income stream in retirement. A lot of people bought dividend stocks or dividend funds thinking that they were going to create a really impressive dividend stream where, last year you could have gotten into T. Rowe Price or Whirlpool or Invesco and gotten a dividend of about 3% per year plus these big solid companies.
Yeah, and here's the thing: and we got to make sure we say not just dividends, but big dividends, right? These are companies
big. Well, it's 3 or 4 times, at the time.
4% or
5
more
in some cases, yeah.
Yeah, I mean, the numbers are kind of astounding because Whirlpool you just mentioned down 25% with.
Well, no, wait,
yield.
that's the net yield. After the dividend. Your net return after the dividend is negative 26%. Wait a minute, how safe was that dividend?
And then the T. Rowe Price fund down.
No, T. Rowe Price, the company. That's the company.
T. Rowe Price, the company down 37.2, et cetera, et cetera. Simon Property down 33. There's a free lunch somewhere. This is I can make money. I can pay myself somewhere without worrying about it. And it's not true. High dividend paying stocks generally are riskier because generally.
Well, they're stocks.
their dividend is higher because their price has gone down. Not always generally, but sometimes they pay them out big dividends for other reasons as well. Remember, when you own fewer of something, you're taking more risk. This is not an easy strategy. This is not one that we recommend, nor would we recommend it today either. So this is, but I find it strangely familiar because I've heard this many times before. Just own this group of stocks and you'll make plenty of money. Or get plenty enough return to pay a bill.
And the reality is, you cannot. How are you feeling right now if this was your source of dividends? Bingo. If you built this this is why we want you to create these really, really stupidly diversified portfolios. To you, they feel stupidly diversified, but in the long run, they end up being brilliantly diversified. And you end up feeling better and doing better. And we're going to talk more about that during the course of this hour. But let's head for the phones. 855-935-TALK is our number, and Lisa is up. Hi, Lisa. Welcome to the program.
Hi, Tom and Don. Thank you for taking my call and for all that you do.
Thank you. What can we do for you?
Well, I'm calling from Portland, Oregon, and I have 3 questions, if time permits the 3 questions.
Sure. Go ahead.
The first one was about bonds. I'm rethinking the placement for my bonds. And originally my plan was to have a mix of tips of short and medium term treasury bonds in my tax advantage accounts. And now I'm reconsidering that and thinking of buying them directly from Treasury Direct to avoid fees. And I was just curious if you see any pitfalls with this idea, excluding taxes.
Well, it depends on where you're going. Okay, at Treasury Direct, obviously you're not going to pay what we see in this industry a lot, where people don't understand there's difference between the bid and the ask. You end up paying a fee to get that bond. If you buy them directly from Treasury Direct, you get rid of that. That's good. The bad news, frankly, is that if you own a Vanguard bond fund, the aforementioned tips, you probably get it at, I don't know, a few basis points, Don. I mean, it's very, very low.
It's very, very, very inexpensive. And I think you're going to get to the problem, and that is you got to create a buying discipline, which most people can't do and don't do well.
You don't end up with as much diversification, et cetera. So
yeah, but here's the buying discipline issue, because what's great about a bond fund, a short intermediate term bond fund like Vanguard or Fidelity or any of them have, these very inexpensive short intermediate term bond ETFs even, which are much cheaper. What's so great about them is that as bonds are maturing, as the 1 year bond that you bought is maturing at the end of the year, they go out and automatically rebuy at the longest maturity to replenish the portfolio, and the yield goes up. With your own Treasury Direct account, you are going to have to be so disciplined that the minute one of your bonds matures, you immediately have to buy another one. And I don't know of very many people who are that disciplined. One, it takes a lot of work, but two, it takes a lot of intestinal fortitude.
And I will just add, and Lisa will take your next question here in a minute, but I would add that the reason that we own bond funds, you can own bond exchange traded funds or mutual funds at an exceedingly low price. Number two, you get professional management. Number three, as Don just said, the work gets done every single day so that you do not have to do it. Go ahead.
And one more thing real quickly. BND, the Vanguard Bond ETF, costs 0.03% That's all.
Yeah, I realized I was
what they call basis points.
Pay about four basis points. I realized that. I was just thinking, why pay it when I don't have to pay it? Because that four basis points is only, again, if you've got a 4% bond, it's 1/100th of your yield. So therefore, is it worth paying a little bit for them to do all the work for you? And it is, you've got to believe me, as somebody who used to work in the trenches buying and selling securities, it's even for individuals, it's work. You got to sign in on a regular basis. You got to pay attention. You've got to overcome your emotions and force yourself to go ahead and buy anyway. Laddering can work, but laddering is work.
What's your next question?
Okay, good answer. The next question has to do with selling my home. So I own my house outright, mortgage is paid off, and was planning on retiring in 2023 and selling my home at that time. Unfortunately, the market may go down, but that was my plan. And my partner and I are waiting to get married until I turn 60, and that's for survivor benefits from my ex-spouse, potential. So I would file and suspend on whatever Social Security is higher. My question was, is it calendar year that I sell my home that matters to get the married filing jointly amount of $500,000?
I tell you what, we've got to take a break real quickly, Lisa. We have to take a break. A couple of things there, but we'll cover those after this. 855-935-TALK, our phone number.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
All right, we're talking to Lisa. She's got a couple of questions at 855-935-TALK. We're talking about selling her house. First thing you mentioned, though, was filing and suspending at age 60. And they've changed the rules when it comes to file and suspend.
Yeah, they got rid of that unless you're born, I think it's prior to 1954.
I realized that. I was talking about survivor benefits. And that's still the same.
Survivor.
Okay.
I'm sorry.
Yeah.
Sorry, misunderstood.
Okay. All right.
Now, as for the house, yeah, you're married filing jointly if you're married in the tax year.
Okay, so it
Because
doesn't
you're-
matter about the
Anytime.
date.
Anytime.
Okay.
Nope,
Because
anytime.
Yeah, anytime during that year, because you will have been considered married in that year because you were married in the tax year, and you're allowed to file as married filing jointly in April of the following year.
Okay,
And Don
perfect.
does that on
Okay.
weekends. He's an officiant, so if you need any help there, he could show up and
No,
marry you.
actually, my brother got that fake license to marry my
Card.
daughter or something. I don't know. I don't do that.
Wait, your brother married your daughter?
Yeah,
Wow, I don't know
he
if I'd be talking about that.
officiated.
Okay. Just want to be careful there. That's all. All right, sorry.
When you have one more, Lisa.
right, Lisa.
What else?
One
Hit
more.
us.
One more. This may be a little longer, and you may not be able to answer this, but okay. Do you have time to ponder the success of me not outliving my money if I retire in June of 2023? And I can give you some background if that helps.
Well, sure. Why?
Take a shot at it.
Yeah. How much money do you have?
Well, let me start from the beginning. I have a pension at 60 that's going to be about $3,200 a month, and with cost of living adjustments. I have a 80-20 stock bond allocation. 25% is in a Roth, 75% is in a tax advantage account. I'm low on cash. I have about $10,000, but I'm building up my cash bucket now. I have a paid off mortgage. My cost of living expenses, I've already anticipated at $60,000 per year. I will take my Social Security at 70, and my partner will be at full Social Security age this December. But we'll delay. He's still working. He's going to delay as long as possible. So that being said, of that $60,000, his Social Security and my pension will cover pretty much all of that $60,000. And I'm planning on taking 2% out a year for my retirement funds. And
2% of the.
You called this question in online. I answered it yesterday. I'm pretty sure it was you.
Oh, okay. Well,
But that's okay. You are going to, how much money do you have in your investments?
Yeah.
Well, 1.4 million. But
Yeah, you're fine.
Being said, I do my net worth statement December at the end of the year, even December of 2021. So I'm sure it's gone down. I bet it's gone down 20% at least.
That's okay. How much do you have outside of your retirement accounts, your tax advantaged accounts? Total money.
Well, I have a Roth. And
Outside of the Roth.
Outside of the Roth. That's where I was.
Outside of the Roth.
Cash. That's where I.
But no, I mean in brokerage accounts. In brokerage accounts that are not under an IRA umbrella.
A zero.
Oh, okay. So your 1.4 million is entirely in retirement accounts, correct?
It's in between 25% Roth and 75% tax advantage account.
Are those IRAs?
Yeah.
Okay. Well, you could just take 2% per year out of those accounts because you'll be over 59.5 and then wait till you collect your Social Security. And that should take care
And
of
you
the
may not
extra
want to
2%.
wait. You may not want to wait on Social Security until 70 if you have no income between 60 and 70. That'd be the kind of thing to get a plan to look at all that, to whether or not that is optimal, because it may or may not be, frankly. But that's a sideshow in a way. Don's exactly right. If you have 1.5 basically, and you're only going to take 2% out of that a year, that's a pretty healthy number to add to the pension and the other benefit, I think you're going to be fine.
I cannot imagine any scenario, I don't care how aggressive your portfolio is, in which you would run out of money before you run out of life. Thanks for the call, Lisa.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Reality radio for a really great future. We're talking real money.
We're here. We're here. We're here to help you. We're actually here. We're physically in the rooms. Tom being in the museum, me in the Florida studio. And if you haven't visited the Model Military Aircraft Museum,
you won't
the
get
Museum
to
of Modern Military
closed
Aircraft
permanently.
You've missed out. You've missed out. It's one of those rare moments.
You can see it though online.
You can if you go to watch our video cast.
That's
in fact,
right.
you
It's
can
right there.
even. If you go to the latest video cast at YouTube or TalkingRealMoney.com, you can actually see Tom play with one of the planes.
Oh, God's sakes.
Remember,
That's not one of the
you
planes.
did. That
That's
was
not
a
one of
plane.
the planes.
That's
it's
a plane.
but not one. It's not one of the planes.
It's a plane, and it's in your. It was in the museum.
Okay, fine. Okay, go watch. That's pretty exciting.
I know.
And to date, I have not fixed that. It's sitting on the workbench. I got to do that.
Would you
actually.
get busy? Shh.
I know. I
What
don't
kind
do
of
anything.
curator are you? Hello,
Not a good
everyone.
one.
Don here, Tom there. This is Talking Real Money. We're so glad you're there. We're trying to help you get through life a little bit better, just like Lisa. She's trying to plan. This is what the idea for the hour was. How do you plan for income in retirement? Because it is a process that requires some planning.
Well, and Lisa brought up a great point. Like, okay, I need to supplant my income in relatively soon, my regular income. Does this kind of work? If I wait on Social Security, I take the pension, and I have these other assets to live on. If you're only drawing out 2% a year, then yeah, your portfolio should survive, but it depends on how that portfolio is invested, right? Because if you have it all in CDs paying 2% and you're drawing out and inflation, then it won't work. You can see that pretty clearly. But there's a few other things you really ought to think about. And by the way, when I meet with so many of you, and thank you, by the way, for those of you who now filled up my Saturday mornings, because
Hey,
we
you
made that
offered.
wonderful offer. I
You
know. So,
offered.
I know. Got out of bed today. I was like, oh, that's right. I got meetings. I'm always astounded the number of you, and I know your heart's in the right place, but sometimes your finances aren't. You don't know how you are invested. Mm-hmm. You got to know that. That's number one, especially as you get closer to retirement. Number two, and you've harped on this, Don, and I think correctly so. Know what rate of return you need rather than.
Oh, yeah, please listen carefully. The word need modified that. How much income do you need?
Yeah. And again, Lisa was like, well, I'm 80% in stocks, 20% in bonds because I want to make a lot of money. I heard that a little bit there. Well, that's great, but do you need to make that much? Are you willing to accept the volatility, which is my number three? Know the volatility you have to face to be in that portfolio. In other words, this is a good year for that, to discover that a bit, right? Because the S&P 500 is down 17%. A 100% globally diversified portfolio is down 14. But here's where the rubber meets the road.
Meets the road.
60-40 portfolio, 60% in stocks, 40% in bonds, is down 10.3. Let me say that again. A balanced portfolio, if you will, has lost 10% year to date, which is not abhorrent. We've had worse years, but the thing that's been unusual this year is stocks and bonds are down. Intermediate term bonds down about 10%. So stocks have gone down, bonds have gone down, but you need to know what you can handle emotionally, financially, and then sort of how that fits into your plan. I find most of you do not. You got to have that. It's just something you need to be completely aware of, especially if you're in the retirement red zone of, let's say, 5 years before retirement. Those are absolutely critical. You have to know those numbers.
Yeah, and I want to do a little contrast and compare here, something that my kids did in school. We didn't do that when I was in school, but I was in school back in the dark ages when, we actually,
I would have failed.
We had chalkboards and things.
Want me to make that sound for you? Okay.
Yeah. You just mentioned 60-40, a balanced portfolio. Well, Dimensional Funds, a company we really respect, they invest internationally. They use a lot of the same techniques that we believe in. They have a 60-40 mutual fund. 60% stocks, 40% bonds. They have a fund.
They do. One fund.
And its yield is...
That you can't buy, by the way.
No. I'm just using this for comparison purposes.
No,
you can't buy the fund.
Public can't buy it.
You have to get it through an
They
advisor.
don't have it in ETF version yet.
But I'm trying.
The
point is, as I'm, looking back, we talked about the dividend stocks at the beginning of the show, where before the crash, now their dividends are quite high right now, but before the crash, their dividends were 3 to 4%. And you mentioned that the total return on a balanced portfolio was just a loss
down
of about
10%. Yep.
Well, the DFA 60-40 portfolio has a yield right now of 1.74. And when we get back, I'm going to tell you how much it went down.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
We're talking about creating income in retirement and how you go about doing it. And one of the things that we want you to focus on is the broad diversification that helps bail you out of rough times more often than not, even though there's no such thing as a perfectly balanced between risk and return portfolio. There's no way, in other words, to make good money and take no risk, have no volatility.
Yeah, I think that's exactly right. The other thing is that we need to think about is people have a tendency to look at their investments and think, well, how is this going to pay me? I am a believer in what might be called a total return philosophy. That is, you build the right portfolio, and then when you rebalance it, you sell things hopefully that have gone up, and you pocket the difference, or you rebalance your portfolio to the things that have gone down. That has not worked this year so far, but being balanced has worked better than just simply using a dividend type.
It has,
play.
and that's the point we wanted to make over the course of the hour. Earlier in the hour, we talked about a number of popular dividend-paying stocks. These are stocks with great dividends, 3, 4, 5, even 6% on some of them, but their net return in 2021 so far, in these many cases we mentioned, Invesco, Whirlpool, they had negative total returns in the 25 to 30+% range. That's
pretty
a
significant.
Big hit. So
that is.
Compare that with the Vanguard. Let's compare that with the Vanguard Balanced Index, which is
one fund. It's designed to be balanced between stocks and bonds.
U.S. and international.
They do the work for you.
Yeah.
They do the work for you. You don't have to do anything. You just put the money in there.
And by comparison, you didn't get the kind of yield. But we're looking at total return. Remember, total return. The total return on those individual stocks was a negative 20, 30+%. The return on the Vanguard Balanced Index so far in 2021 has been a negative 15.5%. 2022. I forget which year it is.
That's okay.
The return on the globally diversified, a little bit more small cap, a little bit more value, DFA 60-40 porportfolio has been a loss of 12.8%. And
so they've done a little bit better.
And on the portfolios that we manage, we've been around 10 plus something percent negative.
Yeah, a little, just a hair over 10, which is, again, all of those things you would expect.
Because of diversification.
Yeah. And more specifically, the one part of the market that's done almost the worst globally is the Standard & Poor's 500. And this is, again, not surprising because we talked about this, and we'll spend a little more time next hour, that the 5 stocks that sent it straight up last year have in many ways gone straight down this year. And that's one of the dangers of a concentrated position, both in those stocks and in just the Standard & Poor's 500. That is 500 stocks. We want you to own 10,000 plus, because that's worked out better over the long haul.
And it's very interesting. I read an article today that was at MarketWatch, but I found it somewhere else, so I don't have to pay MarketWatch, which I refuse to do. I did find the article somewhere else. Mark Holbert, our good friend, wrote a piece that he interviewed a guy who's had a system for a few years. that has been accurate in predicting long-term future returns of the S&P 500. I don't want to say the stock market. I want to say the S&P 500.
Yep.
His forward-looking prediction, and we don't believe in these, but let's just play for a minute. Let's just play pretend. We're going to play make-believe. Let's believe we believe this. He said for the next 10 years, the net negative return for the S&P 500 will be about 3.5% per year. Now that,
Wait
on
a
the
minute,
face
that
of
the
it,
S&P will lose 3.5% a year for the next 10 years?
that's what he's saying.
Wow.
That's what he's saying.
Fairly negative.
But we need to take something into account. One, he's predicting the future, and he's kind of negative. Two, this is not something we've never seen. We saw a very similar scenario, and you all were there for it, unless you're under 12 years old.
Or 20. Let's say 20.
Well, okay, but, I mean, they were there for
You
part
were
of it.
there, but you weren't paying
any
attention.
Okay, under 20. Yeah. When the S&P 500 for 10 solid years, 10 years averaged a negative return between 2000 and 2010.
Now, by the way, does this sound familiar? It followed an era where the S&P 500 was the dominant index.
Right.
The 95 through 99, all you had to do was buy those 10 tech stocks and they went straight to the moon. And then what happened? The moon set in the west.
The moon set.
Disappeared.
The moon crashed and burned.
The moon crashed. Because it was, so again, portfolio concentration is a bad idea. But at the end of the day, what you're really saying is,
well, no,
when you retire, there's
but
no panacea here.
Yeah, I also wanted to make this point, though. If you had, which was a very typical portfolio of 60% stocks, international stocks, and 40% bonds, that balanced portfolio that we talked about, you, get this, you made 6% per year, and after adjusting for inflation, you made 3.6% per year.
In the lost decade.
In that lost decade, because you diversified. This is why we harp on this. Yes.
And you didn't wake up one day, say, I'm going to retire. I'm going to put it all in high dividend paying stocks that are going to take care of me, because those stocks have periods of horrible performance, just like you've seen recently. And that is a concentrated position that is just riskier than you need to take. I'll put it that way.
Yeah. I mean, think about this. This was a very, very bad period from 2000 to 2009 into 2009 or beginning of 2010. It was a very bad period for stocks. It scared a lot of people. A lot of people thought the world was coming to an end. A lot of people who owned a lot of stocks went to cash either in 2000 or in 2008. It was frightening to invest in that period. It was awful. We lived through it. However, those who built these diversified portfolios with stocks and bonds and U.S. and international, not only did they live through it, they could have pulled out 5% per year and still grown their money.
Yeah, that's a very good point, by the way, because you hear all these things about the balanced portfolio. The 60-40 is dead. The 4% withdrawal rate is kaput. It's over.
If it didn't die in the lost decade, then
exactly.
I mean, it's going to take a horrible scenario to kill it.
So getting lost isn't enough, apparently.
No, getting lost is not enough. Yeah. Zombie apocalypse is really pretty much the only thing I can think of. That's going to take
meteorite.
Well, no, it's got to be a meteor. Meteorites.
You mean not big enough?
I'm thinking asteroid.
If it hits you on the head, a meteorite's enough at your age.
Oh, if you hit me on the head with a hammer, that's enough at my age. I'm out.
I was just making funny because yesterday people may or may not know it was Don's birthday.
Please don't rub it in.
Okay. And he's still able to celebrate it by eating on his own, which is good. Yeah. With his own teeth.
Yeah, the only good thing about yesterday was we went out to dinner. Other than that, it was a really awful day. The AC's broken. Dog was sick.
This is not your brightest birthday, but that happens. You got to fight through those because you hope next year's better. That's all.
Not a chance. No, it's all downhill from here.
Not celebrating it next June, huh?
I am done. You know what? They were fun when I was like under 12.
Oh, yeah. Sure.
Oh, they were fun. You know, you got
Good
to go
times.
to Elitch's, all that stuff. All right, 855-935-TALKS, our number. Be right back.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And you know how we discussed the need for understanding your portfolio? You need to know what you own and what you should be owning. But mainly, if you kind of get a clue for what you own, you can start planning for the future. And one of the ways you can really figure out, and I know it's confusing, when you look at it, you go, I don't know what I own. I don't get it. I got all this stuff and I don't know what it means. What you can do is set up an appointment with one of our advisors at Vestory by Appella. These are people that have worked with Tom and me for ages. And they will help you free. We're not talking about just a consultation. We're talking about free, no sales pitch. Just go to Vestory.com, Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That is to keep the lawyers happy.